Markets for long-term funds facilitate the mobilization of capital for entities seeking to finance long-term projects. The two main segments are the stock market and the bond market, which provide platforms for trading equity and debt instruments, respectively. These markets enable companies to raise finance by issuing shares or bonds to investors while offering liquidity to existing holders. Primary markets handle new issues, while secondary markets allow investors to buy and sell existing securities, thereby promoting price discovery and efficient capital allocation. Active and transparent capital markets are crucial for economic growth, as they channel savings into productive investment. Stock markets provide a mechanism for companies to obtain equity finance through initial and subsequent share issues. Listing on a recognized exchange increases public visibility and investor confidence but requires adherence to strict regulatory and disclosure requirements. Once listed, companies can use rights issues or private placements to raise additional funds. The continuous trading of shares allows market participants to assess company performance through share price movements. Analysts, brokers, and institutional investors play essential roles in maintaining liquidity and stability. For issuers, stock market access reduces dependence on bank loans and diversifies funding sources, although exposure to market volatility remains a key risk. Bond markets, on the other hand, cater to entities seeking long-term debt financing. Bonds issued in the primary market provide fixed or floating interest payments over time, while the secondary market ensures liquidity for investors. Corporate bonds, government bonds, and supranational bonds differ in risk and return profiles. The bond market reflects macroeconomic variables such as inflation expectations and interest rate movements, influencing the cost of debt capital. Transparent rating systems and regulatory oversight enhance investor protection and maintain confidence. For issuers, bond markets offer flexibility in maturity, denomination, and structure, accommodating diverse funding needs across industries. The issuance process for both shares and bonds involves multiple participants, including underwriters, legal advisors, rating agencies, and regulators. Investment banks underwrite and distribute securities, ensuring successful placement. Legal advisors handle compliance with securities laws, while accountants verify financial disclosures. The role of advisors is critical in determining optimal pricing, timing, and structure of issuance. For large offerings, syndication spreads risk among multiple underwriters. Proper due diligence reduces the likelihood of mispricing or legal disputes. In this way, advisors act as intermediaries linking issuers with investors, enhancing market efficiency and credibility. Capital market efficiency depends on transparency, regulatory enforcement, and investor confidence. Developed markets like London and New York exhibit high liquidity and accessibility, while emerging markets may face challenges such as limited investor bases and higher transaction costs. Technological advancements, including electronic trading platforms, have improved speed and efficiency, widening participation. However, market volatility, speculative trading, and interest rate shocks can disrupt stability. Regulatory bodies like the Financial Conduct Authority, FCA, or the Securities and Exchange Commission, SEC, play key roles in monitoring market behavior, protecting investors, and ensuring fair disclosure standards. In conclusion, markets for long-term funds are vital in connecting surplus savers with deficit units, fostering innovation, and sustaining economic expansion. For organizations, effective participation in these markets provides access to a broad pool of investors, flexible financing options, and enhanced corporate reputation. The finance function must evaluate market conditions, assess investor sentiment, and engage with advisors to choose the optimal mix of equity and debt instruments. In a globalized economy, integrated capital markets enable cross-border financing, risk diversification, and portfolio optimization. Thus, understanding and leveraging these markets form a cornerstone of strategic financial management.